Hello and welcome to this video edition of the Market Share. I'm Paul Gifford, Chief Investment Officer of First Source Wealth Advisory Services. Joining me today is Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. Inflation and interest rates are two of the most common concerns amongst investors and our clients. And both have the ability to either lower our economic growth or hurt corporate earnings. So you can see why they're of concern. Now, if you were to go through searches on Google, you'll see that there's a spike in the amount of searches for inflation. And just like we've seen a spike in inflation rate, I'd like Eric today to share with us a little bit what's happening with that spike in interest rate or inflation and what's contributing to it.
Sure. Thanks, Paul. Well, the graph on the screen shows the inflation gauge as used by the Federal Reserve. Their goal over the long term is to average inflation at 2%. In the short term, they want, or they're desiring it to run higher than that, because as you can see on the chart again, inflation for the past 10 years has been mostly below 2%. In regards to the latter part of your question, inflation has mostly been affected by really supply shortage of virtually everything, from computer chips to used cars. The federal government's done a great job in creating demand through massive rounds of fiscal stimulus. The Federal Reserve has done it through unprecedented levels of monetary policy, but there's still there's still incredibly low inventories at businesses and from customers. Backlog of orders are high, and the labor markets are quite challenging, all leading to a shortage in supply.
So clearly several reasons why we're seeing a general rise in prices at the consumer level. Now, one of the other things that doesn't get talked about too much is that while we're seeing rising prices, there's other benefits that are actually tied to inflation, such as Social Security payments. So how would the rise in inflation impact things like that?
Sure. And the answer to that, Paul, is fairly simple. Anything tied to a cost of living adjustment, also known as COLA, which Social Security benefits, disability benefits are tied to that. Many occasions disability benefits will likely see their largest increase in over a decade. The Consumer Price Index, which is used by COLA, is on pace to increase by its largest amount since 2008. And that's not a trend that we see changing by year end.
So at least some of our Social Security beneficiaries would see a little bump in their monthly checks that they receive. Now, Eric, let's switch over to interest rates. Historically, when we see a rise in inflation like this, it's been pretty much all of time, you would expect interest rates to rise. That has clearly not been the case recently. So can you give us some thoughts on that relationship and what we expect going forward?
Yeah. So the chart on the screen shows you the positive relationship between inflation and interest rates over a longer period of time. As inflation rises, so do interest rates, as measured by the 10-year U.S. Treasury yield. That historical relationship has broken down the past few months as inflation has been at much higher levels than both Treasury yields and investment-grade bonds. We believe that large difference will subside over the coming months, probably into 2022, as inflation will come down from where the high levels that it's currently at due to the short-term nature of many of the things contributing to the higher levels of inflation. But we also believe that bond yields will meet it somewhere in the middle, as we expect the Federal Reserve to start talking more and more about raising rates, possibly raising them sooner than they expect to raise them. And ultimately, we just believe that investors are not going to settle for yields that are so much lower than where inflation is at.
Well, as two individuals who have been managing money for several decades, it is a very unusual time to see interest rates and inflations like they are. So I like your comments on that. Lastly, this is something we are going to be watching closely as our team, and we'll be sharing further updates with you. To our clients, thank you very much for the opportunity to work with you, and have a great day.